A major development in the financial industry over the last 20 years has been the growth of responsible investing. This is a huge subject that's made all the more complex by a lack of standardization and a proliferation of technical terms. For us at Sparrows Capital, socially responsible investing, or SRI, covers a broad area, bounded at one end by traditional return-focused investing and at the other by philanthropy. This span incorporates ESG, or environmental, social and governance integration. In other words, it broadly means investing in a way that benefits the environment and wider society, and that promotes sound corporate governance. But it also includes so-called impact investing, a more radical approach. Sparrows Capital designs responsible portfolios to address the ESG SRI spectrum, the broad market exposure which forms the core portfolio for most investors. We don't specialize in impact investing, which requires more active intervention by specialist managers. It's very important to understand that responsible investing involves a trade-off, at least in terms of expected outcome. On the one hand, the aim is to generate healthy financial returns in line with the overall market. On the other, it's to ensure that capital is invested in a sustainable and responsible manner. Those two things aren't mutually exclusive, but there is inevitably a balance to be struck. For this reason, investors should treat with caution any claims that responsible investing will automatically deliver superior financial returns. There have been times during the COVID pandemic, for example, when responsible portfolios have outperformed. But in 2022, for instance, they underperformed against a background of geopolitical tension. In the long run, the returns from responsible investing will diverge from those of the broad market. That means that the returns may be lower than those achieved by investors as a whole, and this is a price that responsible investors should be willing to pay. In other words, ESG is not a factor like investing in value stocks or smaller companies that we expect to generate higher returns than the broader market over time. You should see it instead as a filter which removes stocks in objectionable industries and underweights those with lower ESG scores. So how do you filter out companies that don't belong in a responsible investment portfolio? Well, that's another issue that makes responsible investing such a minefield. For a start, some companies are more transparent than others about how sustainable or ethical they actually are. Assessing a company's green credentials is also very subjective. A stock that one responsible investor approves of, another investor may disapprove of. There are several ESG ratings agencies which rate each stock according to how highly it scores for each category: environmental, social, and governance. Each agency has its own way of doing things, and different agencies inevitably reach different conclusions. But as the sector becomes better regulated and the rules more standardized, ESG ratings are providing an increasingly accurate picture. Here at Sparrows Capital, we generally favour ESG SRI indices from MSCI ESG Research, one of the world's largest independent providers of ESG ratings. MSCI provides ratings for more than 400,000 equity and fixed income securities to more than 6,000 companies around the world. So, how does Sparrows Capital build responsible portfolios? The first thing to say is that we use index funds and ETFs. Why? Because they're cost-efficient, transparent, and offer broad diversification. They also provide daily liquidity. We favour index funds and ETFs that track the MSCI SRI Select Reduced Fossil Fuels Indices. This index series excludes firms involved in the extraction and production of fossil fuels, as well as coal, oil and gas-based power generation and the ownership of fossil fuel reserves. It also filters out companies that derive more than a specified percentage of their revenues from industries such as weapons, tobacco, gambling and nuclear power. The MSCI SRI indices lie at the more rigid end of the spectrum, reducing the investable universe by some 80%. This is why the portfolio and its performance diverge from the broad market. The equity component of our portfolios is built up from regional ESG SRI investments, accessing listed equities across the globe. Here are some examples of equity ETFs that meet our current selection criteria. As for fixed income, we remain unconvinced by the ESG funds currently on offer, and so we restrict fixed income holdings within our responsible portfolios to developed sovereign exposures. And that, in a nutshell, is our take on responsible investing. Bear in mind, though, that despite its growing popularity, responsible portfolio construction is still a fledgling discipline. While it's true that the rating sector and the products on offer have improved, they will improve further. Sparrows Capital will continue to assess the latest research and product offerings to provide investors with the best possible solutions.